Hello everyone, great to see so many of you here. And you join us at the end of what's been another really busy year in markets. So as always, I'm going to do my best to try and make sense of it by looking at some of the bigger talking points we've seen this year. And I've managed to narrow it down to a top 3 things. So here we go, starting with number 3, and we've got rate expectations. This is interest rates, of course. And before doing this, I did ask our good friend ChatGPT for each of these sections, can you come up with a funny name based on a film, TV, or book title? Sadly, that was the best it came up with. But some honourable mentions perhaps to Dawn of the Dead, not bad. Desperate House Buyers, yeah, really not sure about that one. So interest rates have been coming down this year. And generally, this is good news for the stock market, partly because lower rates makes borrowing cheaper, which pushes the economy up. But also, without wanting to get too technical, lower interest rates increases the present value of a company's future cash flows. So it literally pushes up equity valuations. And as you can see, this year, the interest rate has come down 3 times, likely to be a 4th tomorrow, a total of 0.75%. But who's in charge of making these decisions? Well, for us, it's the Bank of England, and specifically the Monetary Policy Committee, or MPC for short. Here they are, there's 9 of them, headed up by Gary's favourite person, Andrew Bailey, former chief exec of the FCA. And he's joined by 8 others here, and they're mostly a range of senior economists and bankers. As lineups go, it's not exactly Strictly, is it? Maybe the traitors, perhaps. But no, they're all well qualified for what they're doing. And this committee, they'll meet up 8 times every year. They'll talk about what the economy's doing, and eventually they'll decide what the interest rate should be. And they do this by having a vote. And this next chart shows you how each of those votes has gone in each meeting for the last 10 years. So grey here represents a vote to keep the rate as it is, green is a vote to reduce it, and red is a vote to increase it. So for example, you can see in early 2020, when the pandemic was happening, they all voted to bring the rate down to its all-time low level. Then for the next year and a half or so, they all voted to keep it that low. Then in late 2021, they mostly started to vote to bring it up. And the last 2 years, they've been gradually voting to bring it down. But the thing I found fairly interesting about this chart is how the number of unanimous votes has changed over time. If we highlight all of the unanimous votes, we can see that from 2016 to 2022, pretty much every vote, they were all in agreement. But in the last 3 years, this has only happened once. So clearly now the committee are struggling to agree. And it may or may not just be complete coincidence that it was 3 years ago that the UK inflation rate hit that massive 40-year high of 11.1%. And of course, one of the bank's key objectives is to manage this inflation rate. So clearly, they've had quite a tough time of it recently, and maybe that's why the votes have not been so obvious. Now you'll see I've managed to get inflation into this. So you might be able to guess what's coming next. We're about to play our second favourite game, and it involves the basket of goods which the ONS uses to measure inflation in the UK. Each year, they will add and remove items based on current trends. So I'm going to put some items on the screen. Can you guess whether the next item has come into the basket this year, or has it come out? So first up, to get you comfy, we've got a nice cushion. Cushions in or out this year. They've gone in. So the ONS has decided to increase the number of soft furnishings in the basket. DVD rental services, in or out? Yes, these are out, of course, and they've been replaced by video-on-demand services like iPlayer, for instance. Mangoes, are they in or out? These are in, due to a slight rise in the popularity of stone fruits. Men's sliders, these in or out? These have gone in. So according to the ONS, this is a rapidly increasing area in the UK footwear market. So if any of you are wearing any today, it means you're on trend. Next, we've got in-store cafeteria meals. So the sort of meal you get in a cafe in Debenhams, in or out. These have gone out, sadly, due to lots of store closures up and down the country. Virtual reality headsets, these in or out. You see, you're getting too good at this now. Now, in, of course. In the UK, we spent £350 million on VR headsets last year. So these have gone straight in. And lastly, as it's Christmas, minced turkey. It's minced turkey in or out. This is out, I'm afraid. So according to the ONS, there's been a very slight shift away from fresh meats to pre-cooked meats. So minced turkey has come out and it's been replaced by pulled pork. So there we go. Right then, number 2 in the biggest talking points this year. This is bubble jeopardy. So this is speculation over whether we could be about to see another tech bubble. Other names from ChatGPT, Honey, I Blew Up the Share Price, and Charlie and the Chip Factory. You could just about see what they did there. Now, as you may know, for the last few years, the stock market has been dominated by the Magnificent Seven. And this is the nickname given to those big tech stocks such as Apple, Amazon, Nvidia, and so on. From the start of 2023, between them, they've returned 330%. That's an annualized return of 65% per year. So not too shabby. However, this has resulted in some quite drastic skews in the global stock market. So here we've got a measure of concentration of the S&P 500 index, which measures the US, the biggest 500 companies in the US. This shows the percentage of the index taken up by the 5 biggest stocks and the 10 biggest stocks. So it gives you an idea of how concentrated it is in a small number of big companies. And at the end of 2023, this index, 31% of it was made up of just the top 10. By the end of 2024, this had increased to 37%, and right now it's at 40%. So the 10 biggest companies out of 500 make up 2/5 of the entire index. Now, clearly, we've not seen anything like this before. The closest we've come was round about here, which is when the original tech bubble happened. And we have seen some evidence this year that these current tech giants are not completely infallible. You may remember back in January, a relatively little known Chinese company called DeepSeek unveiled its new AI model. And it turned out that this model was considerably cheaper to run than Nvidia's was. So this news sent ripples through the US tech sector, in particular Nvidia, whose share price plummeted 17% in a single day, equating to a loss of about $600 billion. And to try and put that into perspective, if you imagine on this day that all of Nvidia's shares had been shared equally between every single person in the whole world, well, on this day, everyone would have lost $75. The whole world would have been $75 worse off just from Nvidia's one-day share price movement, which is crazy, isn't it? Now, since then, Nvidia's share price has recovered and gone on to reach new highs. But this episode did just give us a glimpse into how precarious these huge tech valuations are. Okay, then, time for number 1. What is the biggest talking point in markets this year? It is a terrific tale. I wonder what this could be about. So other suggestions from Mr. GPT, line of duties. Yeah, okay. And no country for cheap goods. I do actually really like that one. I almost used that. So back we go again to January, and you may remember this man became US president for a second time. And one of his key objectives in this particular term is to boost domestic manufacturing in the US and to reduce trade deficits with other countries. So he decided to impose a series of tariffs between the US and pretty much every other country in the world. He unveiled these on what he referred to as Liberation Day, back on the 2nd of April. And the big question is, how did markets react to this? Well, there's really only one way I can show you this, if you'll bear with me a moment. There we go. So these are just some of the countries that Donald Trump imposed tariffs on back in April. And this column in red here is the amount that that stock market fell in the week following the announcement. So you've got China there, down 12.3%, EU 13%, Taiwan there, down 18%. Even us in the UK, we got off fairly lightly, just 10% tariffs, but FTSE 100 still down 11%. And finally, at the bottom there, the US, the country imposing the tariffs, well, they got hit too. S&P 500 down 11.5%. So clearly, markets did not react too kindly to these announcements, and unsurprisingly, there was a big spike in volatility. And volatility is something that we like to control in the funds, so we monitor it very closely. And here we've got the rolling 30-day volatility of the fund returns for the last year. And by rolling 30-day volatility, I just mean if you take any point during the year, how much variation has there been in the last 30 days worth of daily returns. So you can see we've got this huge spike at the start of April caused by the tariffs. And this yellow line here, that is the global stock market measured by the MSCI World Index. But you'll notice that the growth fund in red here, even though the growth fund went into this crash with more than 100% equity exposure, it actually suffered a lot less volatility than the market did. And that's because we diversify. We saw in the bubble section just now, just how concentrated the market is in a small number of massive tech companies. And those tech companies got hit quite hard during this crash. So by diversifying away from those, we suffered less volatility. Now, the other thing I'll mention about this chart, and this may sound a bit obvious, but you'll notice that the balanced fund in green here, at all times, it's below the growth fund, so it's less volatile. And the Courtiers Fund in blue, at all times, it's below the balanced fund, so that's less volatile. So this chart is effectively telling us if we're doing our jobs correctly. If, say, the Courtiers Fund was showing more volatility than the growth fund, then that would heavily imply we're doing something wrong. Thankfully, in the 18 years that we've been running these funds, that has never happened. Now, sticking with volatility, and this is the VIX index. This measures the implied volatility in the US market based on how expensive put options are. So it's often referred to as the fear index. Here it is over the last 25 years, and there are some obvious spikes here. So you've got the global financial crisis in 2008, COVID crash, of course, in 2020. And it turns out that the tariff slump that we saw earlier this year is actually the third biggest spike in market volatility of the last 25 years. Now, believe it or not, you can actually invest in this index. You can buy futures in it if you want. So you could place a bet on what you think is going to happen to market volatility. It's not something we've done directly, though, partly because it turns out that the VIX is itself quite volatile. So here's the volatility of some big asset classes. So you've got gilts down there, not too volatile. Some equity indices, a bit more so. And then, of course, Bitcoin, renowned for its volatility. Where does VIX sit amongst these? Well, it's all the way up there. It's 9 times more volatile than the FTSE 100, twice as volatile as Bitcoin. So it turns out that one of the most fearsome asset classes out there is, in fact, fear itself. Anyway, back to tariffs. So we saw that markets did not react too well to Donald Trump's announcement, and seeing the stock market do so badly did not sit particularly well with Mr. Trump's ego. So a week later, he announced some 90-day delays to most of the tariffs, and markets breathed a huge sigh of relief. The S&P jumped up 9.5% in a single day, its biggest one-day gain since 2008. And about a month later, the index was back above where it started going into this crash. Since then, several countries, including us, gone on to make deals with the US, but some countries, in particular China, and we've not had such luck. So the chances are we're going to see more tariff news flow going into the new year. So those are some of the bigger talking points this year. Here's a brief look at how markets have done in general. And it's been a great year for the good old FTSE 100, UK large caps, partly because this index has quite a lot of exposure to materials and metals. So it's outperformed its European and US counterparts. But while large caps have done really well this year, it's not been quite so good for mid caps and small caps, both here and in the US. Other asset classes, well, property and gilts, they've both done okay this year. But because of the strength of the pound, it's not been quite so good for foreign currency assets. So both the yen and the dollar, they've depreciated about 5% against the pound this year. Okay, this is the moment of truth. This next 10 seconds is what keeps me awake at night for most of the year. How have our funds done this year? How have your portfolios done this year? Well, here we go. Courtiers Fund returned nearly 10%. Balanced Fund, 13.5%. And the Growth Fund, over 17%. Then we've got the equity funds. They've all returned 15, 16% this year. And finally, the bond fund doing its job there as a very low risk holding. So needless to say, we're really pleased with how the funds have done this year. It's been a really positive year, even with that spike in volatility that we saw earlier on. So yeah, we're really happy with how the funds have done. But this is what you've really been waiting for, isn't it? Yes, it's play your markets right. I'm going to put some market returns for the year up on the screen. Can you guess whether the next one is higher or lower than the previous one? So you've just seen the UK is up 23%, but what about gold? Higher or lower? It is higher, yes, 61%. It's had its best year since 1979. And this is for lots of reasons, really. Central banks have been increasing their buying of it. The weakness of the dollar has made gold more affordable. And investors do like to see gold as a safe haven asset whenever there's volatility in traditional markets. And of course, we saw that huge spike earlier in the year. So gold has done really well. What about silver? Higher or lower? It is higher. It's up 95%. For more or less the same reason as gold. But silver in particular has seen a lot of increased interest from retail investors too. So both gold and silver have done well. Anyone guess what's next? There is no bronze index, I'm afraid. So it's me playing a horrible trick. It's copper though. Is copper higher or lower? It's lower, but it's still up 28%. So as you can see, it's been a really good year for metals in general. And that is one of the reasons why the FTSE has done so well, because there are a number of large mining companies in the FTSE. Think Rio Tinto, Anglo American. So FTSE 100 has done quite well from those. Tesla, higher or lower than copper? It's lower, yes, just 6.5%, which is quite modest by Magnificent Seven standards. But you may remember earlier in the year, Tesla's share price slumped about 50% due to protests against Elon Musk and his support of Donald Trump. Since then, it has recovered and just about squeaked a positive return. So Rolls-Royce, higher or lower? It is higher, it's up 87%. And this has nothing to do with cars, of course. The motor business was spun out of Rolls-Royce back in the 1970s. Now the company deals with engines in the defence and aerospace industries, and they've both been very popular in the last couple of years. So Rolls-Royce has done well. Is Bitcoin then? Is that higher or lower than Rolls-Royce? It's lower. It's actually down 3%. Now, as usual, Bitcoin has had its massive ups and downs throughout the year. And it just so happens that as of the end of November, it was down 3%. And we can't look at Bitcoin without also checking in on our beloved Bitcoin. Yes, this is the cryptocurrency developed for the adult entertainment industry back in 2014, I think it was. But is that higher or lower than Bitcoin? It's just a little bit higher. It's up 300%. Now, normally at this point, I make up some awful, crude joke, but not this year. No, I'm not going to make any jokes about tits. Okay? Keir Starmer's approval rating, higher or lower? don't know what you're laughing at. That's exactly. I mean, it's mathematically impossible to be higher, but for the record, it is lower. It's down 9%. According to YouGov, it was 27% in January. As of November, it was 18%. So there we go. Thank you as always for listening. And I know I say this every year, but it is a pleasure to be able to look after your money for you. Have a great Christmas. And I hope to speak to some of you later on. Thank you.